Since January 6th of 2006, Comcast Corp has dramatically outproduced the S&P 500. A $10,000 investment would have produced over $9,262 in dividends in Comcast versus only $5,347 in dividends in the stock market. Capital appreciation would have equaled 9.07% per annum versus 6.9% in the market, bringing the total return in favor of Comcast at 10.25% with dividends paid but not reinvested versus 7.87% on the same basis in the market. But that's not the remarkable part of the story. If you look at the S&P 500, the orange line represents the fair valuation or fair value reference line. It started out overvalued in the beginning, the S&P, and it is currently overvalued at the end. In contrast, if we look at Comcast, it also started out overvalued, but then had the big disadvantage of the stock price falling dramatically during this period here in 2022, and yet this company still outproduced the market. What's the differentiator? A company that's grown at double-digit rates, 19.08%, versus the stock market only growing at 7.26% over the same time frame.
Hey everyone, we are offering 25% off your first payment when you sign up or upgrade to Premium Annual. This is only valid for new users and upgrades to our Premium Annual product. Use promo code BANKING9 in your checkout to claim this offer.
Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, aka Mr. Valuation. And today we're going to look at a dividend growth stock that I believe offers all the attributes that investors are looking for or should be looking for. We've got a very strong earnings yield thanks to a very low valuation. We've got very consistent operating performance. We've got a dividend yield approaching almost 3%, and we have a stock price that offers a very good margin of safety, and we have the ability to analyze why the stock price is down so much and be able to determine whether that is essentially the market misappraising the company or whether the company deserves to be down. In our view, we think Comcast is an extremely attractive long-term buy now. The company is A-rated, has modest debt, and has very consistent historical operating results. So let's go ahead and get into Comcast here via the FastGraphs Fundamentals Analyzer software tool. The first thing I want to do is I want to take price and price-related items off the graph. And I want you to understand what you're looking at here. This company has been in many ways much maligned because, as you see, it's a cable and satellite company. And there's a lot of talk about, cord cutting. People are, leaving the cable business and so on. But Comcast, in spite of all the issues that they've had, the company's really been going through a transformation, if you will. And we've included a research report, a link to the research report that we produced for this company where you can read some of the details. But what I want you to note, with all the negative press and sentiment, and a lot of why the price is down is negative sentiment, and I'll talk about that more, if you really look at the consistency of the operating results, looking at adjusted operating earnings here, I want you to notice that going through the Great Recession of 08 and 09, the company's earnings per share grew very strongly on an operating basis. The company had very consistent growth going forward. They did have one hiccup during the COVID crisis, but still very minor. They recovered very quickly and have been growing ever since. When you put weekly closing stock prices on the graph, you can see that stock prices correlate with the company's operating results. And that's very, very important. Coming into the Great Recession, there were a lot of overvalued situations, including the S&P 500 at large, as I showed earlier in the presentation. But then the correction happened, the reversion to the means happened, and then Comcast got inexpensive during this period of time. And this would have been a very attractive, couple of years where you could have bought the stock, actually for a long period of time here where the stock was trading at fair value. Now, that was a good time to buy the stock. But then you had times where the stock price got extremely undervalued, including in COVID, and those, I believe, are going to turn out to be great long-term periods to buy the stock. Right now, you can buy the company with an earnings yield of 8.93%. I want to see at least 6.5 to 7%. So this exceeds that dramatically. We've got a dividend yield of 2.84%. We can buy it at 11.2 times the blended PE, which I think is extremely cheap. The company's A- rated, only has 51% debt. And going back and looking at this company from a standpoint of performance, I also want you to notice that when I look at the company's historical results, they started paying their first dividend, as you can see here very quickly and easily on the fast graph, in 2008. But if you look at the dividend column here at the bottom of the graph, you'll note that they increased their dividend every single year. So when we look at that from a pure performance perspective, we can see that the average dividend growth rate has been 19.48%. Now, it did slow down into single digits the last 3 years, 9.7%, 8.89, and 8.16. But we are still getting very strong dividend growth because, as I'll show you here in a moment, the growth rate of the company is changing. But it's produced, an earnings yield or a yield on cost that took it from like 1% back in '08 when the stock was, a little bit pricey. And last year, your growth yield or yield on cost would have been 11.66%. That's the advantage of owning a dividend-paying stock. Remember, the dividend is paid on the number of shares you own, not the price per share. And that's a critical factor in investing in dividend growth stocks. So we've seen this steady increase in dividends. We've seen payout ratios in the 25 to 30% range and increasing, over time, holding that payout ratio. Now we're starting to get 30, 35%. But one of the things I've talked about in recent videos, let's look at how you utilize fast graphs. So I've got a 19% growth rate going back. That's the growth of the orange line. Forget the price line for a moment. That's the growth of this orange line from point A out here to point B. Okay, if I shorten that time frame, let's say drop it from the 20-year chart down to 15-year, which does include some forecasting, my growth rate drops to 13.81%. When I put price on the graph, I've got, a reasonable valuation here and undervaluation here. So performance over this time frame will, in my mind's eye, automatically be slightly less than what we saw. And you can see it's 11% instead of 13. But we get almost 13% total return thanks to the dividend, and we still get a very strong dividend growth rate of over 15%. But the point I'm getting at is that we're looking at a period of time here where the growth rate has begun to slow down. That's very typical for companies. And I want to, emphasize that. The beauty of using a tool like this, we can drop this down to, let's say, 10 years, which includes 3 years of forecasting roughly, and the growth rate now has dropped to 10.7%. Okay, if I run this for the last 7 or 8 years, just the last couple of years, where we're now starting to get a balance between history and forecast, I can even drop one more year off of that. Notice that the growth rate has dropped to 8.4%. I drop one more year off that. Now the growth rate's down to 6.2%, where I've got almost an equal amount of historical numbers and forecast. Now, something I like to emphasize to subscribers of the Fast Graph tool, the more recent numbers are the ones you should pay most attention to, in my opinion, because they're the ones that are happening currently. But ultimately, you should make your decision on the forecasting. Now, there are a lot of analysts following Comcast, over 25 analysts, 29, 29, 27, and 19. And the forecasts are for growth to average about 7.3% out to 2025. That would indicate a 22.7% annualized rate of return if we had 7% growth and the stock went to a 15 PE. The normal multiple over this time frame has been slightly higher. In fact, if we go back to the historical graph, and let's do that real quick, and draw this as like a 10-year graph, I want you to notice we start getting a normal PE of 16.5 to 17. And if you look at this graph carefully, I want you to note that there are a lot of times where the market puts a premium valuation on the stock. I don't consider these good times to buy the stock, by the way, but it just simply is the point I'm trying to make is that this stock has traded at valuations a lot higher than 11 times earnings, and there's really nothing going on in the earnings growth here that should indicate that that would be a problem. I also like to go on and look at other metrics here. Since this is a dividend-paying stock, we can see that the company generates really strong operating cash flow, then the dividend is well covered. I can actually take the price and the normal PE off of the graph. And what I want you to see here, this is the cash flow per share of $1.73 covering 9 cents worth of dividend, $1.78 covering only 13 cents dividends. In other words, the operating cash flow is significantly higher than what the company needs to pay the dividends. Looking at other metrics like EBITDA, we also see that the price to EBITDA is also very, very low from a valuation perspective. If I look at price to sales, the price to sales is also very low. Now, the earnings metric I've used, and this confuses people a lot, the operating earnings number I'm using here, this is operating earnings. Okay, this is, more relative to where you're ignoring non-recurring charges, one-time events, accelerated depreciation schedules, and other accounting conventions that are not part of the day-to-day operations of the business. But if you go and look at GAAP earnings, okay, diluted earnings, I do want you to notice that the picture is not anywhere near as consistent as it was when we looked at it, from the operating earnings. But I'm going to have Colton Carnevale go into the financial statement here and show you what the reason for this big drop in diluted earnings in 2022 was all about. And we're also going to take a look at free cash flow and why free cash flow has dropped for these last 2 years. Now, even though free cash flow dropped here, I want to emphasize it's significantly greater than what the company needs to pay the dividend. And this really is a dividend growth stock with a very strong margin of safety, in my opinion, at this period right now. So I'm going to go ahead and turn this over to Colt for a moment and let him go through the financial statement on FastGraph a little bit with you here real quickly.
Hey everyone, Colton here. So the first item that we're going to look at is the drop in diluted and basic earnings. And I'm going to show you how you can find out and kind of audit this data using the tool and things that we provide you with FastGraphs. So this happened in 2022. So where we would go is under the financial statements and check out the income statement. And I like to first start at the bottom and see, just verify that there was a drop in data and then kind of work my way back up to the top and then back down into the middle. We'll go over that here in 1 second. So as we can see, net income went from 14 billion down to 5.3 billion. All right, now that we see this drop in net income, let's go all the way to the top and check sales. So sales have actually increased a good bit over this time. About $5 billion in sales were generated as an increase. So we know that there's some sort of expense in the middle of this financial statement that we can find. And so now we just go down the line and verify the numbers and check. So COGS has relatively stayed the same, and as a percentage of sales has actually decreased. So there was some cost savings there. SG&A slightly increased, but that's probably in line with the increase of sales revenue. EBIT has, EBIT's 22 billion. So our operating income is higher at that point. So we're still not at the point yet. Going down the line a little bit more, we have interest expense being a little bit lower. So that's not the case. And then now we finally come across this unusual expense. So in 2022, they had an unusual expense and specifically an impairment of 8.5 billion. This is a non-cash charge and actually reduces their taxes, but it is an impairment on their investments. So we can actually look into what caused this and what this actually represents if we go check out Edgar. We can go to Edgar from here. We can change this to look at 10Ks only. So let's take a look at 10Ks. We'll look on the most recent one because this is the most recent fiscal year there was the issue. And then if we look up the number 8583, we can see this goodwill and long-lived asset impairments of 8.5 billion. Now, in order to figure out what this 8.5 billion is, we need to take a look at some of the notes on this financial statement that they provide on their 10K and figure out where this is coming from. So what I like to do is I'll search sometimes that either that value more, or I'll search for the name of what that account was. And so we find here that refer to note 10 for a discussion of impairment charges related to goodwill and long-lived assets in our Sky segment. So they are saying that there was an impairment charge of 8.5 billion roughly to the Sky segment, and that's what caused the issue. So let's take a look now at note 10. So I'm just going to search for note 10, and here we go, goodwill and intangible assets. Feel free to go through these tables that they provide that shows how these have changed, but ultimately they provide a statement below that says what happens. So specifically this statement down here, there is assess the recoverability of our goodwill annually as of July 1st, and in result, third quarter of 2022, we recorded a goodwill impairment of $8.1 billion in our Sky reporting unit. Estimated discounted cash flow analysis when performing this considered multiple earnings, comparable public companies, and recent market transactions. So basically what this is saying is there was a goodwill impairment of $8.1 billion. Goodwill is essentially a asset that, let's just use something simple. Let's say a company that Comcast is buying is worth $1 billion on the books, but they pay $5 billion to actually buy the company. Well, in order to record that extra $4 billion over, they record it as $4 billion of goodwill on their balance sheet. And then every once in a while, in this case, that they reassess their goodwill annually, and they assess the goodwill to have an impairment of $8.1 billion this year. Then if we continue down the line to look at intangible assets, we can actually find down here that in connection with our annual goodwill and impairment assessment in the third quarter of 2022, we recorded impairments of intangible assets related to our Sky segment, which primarily related to customer relationship assets. These impairments totaled $485 million and are presented in goodwill and long-lived asset impairments in the consolidated statement of income. So ultimately, there was a goodwill impairment because of the Sky segment, and then also an impairment of the intangible assets related to the Sky segment. So that's a one-time charge that we're going to see. It actually helps save taxes, which is at least a tax benefit, but it did drop the diluted and basic net income values due to that one-time cash charge. That's not going to be something that we see on a recurring basis on the income statement. Now, as Chuck pointed out, if we go back here and look at free cash flow to equity has dropped from 429 to 356. We can see where this drop came from. This one we won't be able to see on a financial statement because this is just what analysts are estimating, but we can definitely check out the one that happened in 2022. So once again, if we go back to the financial statements and this time check out the cash flow statement, we can now audit what happened to the free cash flow and why it decreased. So where we start is the net income. The way that free cash flow is calculated is it's operating cash flow minus capital expenditures. And the way that operating cash flow is calculated is by adding back all the non-cash charges to net income. So as we can see, we have this net income starting line, which we know is low, mostly due to that giant impairment charge. And then we go through all of these adding back of non-cash charges and ultimately end with an operating cash flow of $26 billion, slightly less than the operating cash flow of $29 billion. And just like we did with the income statement, we can kind of start from the top and the bottom and work into the middle and see where those changes happened. So ultimately, our funds from operations were $1 billion lower in 2022 than they were in 2021. So there's already $700 million that we have less in operating cash flow. And then we have an additional $2.9 billion less from changes in working capital. Working capital is current assets minus current liabilities, and then the change in that is the change between 2022 and 2021. That ultimately trickles down into our net operating cash flow like we saw, and then with a slight increase in capital expenditures, we can scroll all the way down and see that we had roughly $4 billion less in free cash flow per share, which ultimately resulted in a less free cash flow per share. If you want to audit that data, you can once again go back to the 10K of the company that we were just in, and we can search for the cash flow statement and try and find those data items in the cash flow statement. Okay, now that we are on the consolidated statement of cash flows, we would find the changes in operating assets and liabilities. There's going to be some difference in naming conventions on different 10Ks, but the last thing on a cash flow statement when calculating operating cash flow are the changes in working capital. So if you were to add all of these up, that would result in the value that we show for changes in working capital, and then ultimately the $26,413,000,000 in net operating cash flows provided. So that ultimately explains what's been going on. Once again, we had a large impairment charge that was a non-cash charge that caused our diluted and GAAP earnings to significantly drop. And then with some changes in working capital and a little bit of lower operating cash flow, we resulted in some lower free cash flow along with, the higher capital expenditures. So the company took some impairment charges and they're also reinvesting in themselves. They're definitely not going out of business. Sometimes companies make bad acquisitions and stuff. It's something to definitely keep an eye on, but that's ultimately what has happened to these two data items.
All right, thanks, Colt. Really appreciate that. So let's kind of summarize what we're looking at here. I want to really emphasize some very strong things. In the article that we included, we talked about how this company has really been a company in transformation and transition. They made some really strong acquisitions, the NBC Universal acquisition recently. The company has really altered their revenue, where their sources of revenue, where they were almost totally dependent on one source earlier. They've now, reduced that dramatically. They're aligning themselves very nicely with the future. The analysts still expect, good, strong 7% growth. Now, I want to make it clear, we're not basing our wanting to buy the stock on what we saw in the past. We've learned from the past, but we're putting our focus on the future. And that's why we've included the research article. We've tried to cover the good, the bad, and the ugly with the company. And I think, a lot of the risk in this stock is already priced into the very low valuation. We're buying this at a time where you've got a strong margin of safety, an extremely high quality company that hopefully is very well positioned. If you look at other research sources and you go through external links, the company had a very strong quarter here recently, strong enough that Bank of America upgraded the company on their very strong quarter, and they call it a media turnaround. And we happen to think that's true. So I believe now would be a very good time to be building a position in Comcast. This may not be the very bottom. We could still run into some bad market here. In the short run, the stock could drop a little bit. But in the long run, I think you're looking at very, very substantial rates of return at very, very controlled risk. You got a nice margin of safety, a good dividend, extremely well covered by financials. And all in all, we like Comcast and think you ought to take a close look at it in your portfolios. The market's sketchy now, and I think valuation is more important than ever before because nothing mitigates risk than that. I showed you the market, as measured by the S&P, still looks relatively overvalued, but Comcast, in contrast, does not look overvalued. It's undervalued. And yet, even though it's been undervalued recently by the market, it's had this big sell-off, it still has outperformed the market. Imagine what it can do when it moves back inevitably into fair value. As long as the fundamentals hold up, I'm confident that's going to happen. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation, offering up this little piece of research on Comcast. We do have a comprehensive research report included. There's a link to it at the bottom. If you like this video, subscribe to the channel, give me a like, and also take a look at FastGraph. Visit our site. There's a lot of things happening on the FastGraph site right now that are very, very exciting. We've added international stocks. We've greatly enhanced our screening tool, and we got many, many more we consider to be excellent surprises in store for you in the future. So anyway, thanks for watching. Look forward to talking to you guys again very soon.